COVID-19 continuing to spread worldwide. The CDC saying it is likely the virus will become a global pandemic. Now, if that warning becomes reality, what's going to happen to our record-long economic expansion? Joining us now for more details is certified financial planner Doug Flynn. Doug, good to see you this morning. Stocks, the market just opened. We're up right now in a big way.
Mm-hmm. I think that has more to do with Joe Biden coming out ahead last night. Sort of a relief that perhaps socialism isn't going to take over, and that's sort of the little look of what's going on in the snapback today. But also the cases, the active cases are down probably more than 20% from the high, so that's things are settling. Even though it's spreading out wider, right, things are settling down. So I think people, the market likes certainty. So the certainty of those things means we can settle in and get back to what we want to get back to longer term with the market.
Wow, that's interesting you bring up that point. Obviously, President Trump had made that point earlier as well, criticizing his Democratic potential candidates there. In the meantime, do you think American investors should be worried about what more could happen depending on what happens with this outbreak? If we continue to see more and more cases, again, we are seeing more and more countries popping up with different cases. Do you think we should be concerned?
Well, I think that concern, not necessarily, because if you look at previous outbreaks, the previous outbreaks have not necessarily had a material impact on the earnings of companies longer term. In the shorter term, they can, and that's exactly what tends to happen. Even if you look at the SARS case in China, where their whole GDP basically shut down, once things settled down, they had a snapback of over 15% the following quarter. So a lot of this gets held back. It doesn't shut down, and then you kind of snap back. You might lose some things that are non-recoverable. But yes, if there's a further outbreak or a second case that comes out and a second wave, that could be concerning. But it doesn't seem like that's the case, so things are getting back to normal slowly.
Talking about the coronavirus, we have seen the numbers in China start to decrease, right? We're watching that. We're watching factories start to open back up, people going back to work in China. True. Does that take effect, this international news, if you will, does that take effect here back in the States as far as the market is concerned?
It does. If you look at China, it was down to about 50 or 60% capacity on its manufacturing, and now it's up to about 70, and it looks like by the end of March they'll be back up to 90%. So if that's true, that's the precursor of what's to come here. So certainly there was a pause, and the supply chains have diversified into other countries. So I think things are improving over there as well, and you can tell by the outbreaks as well. Things are settling down, so perhaps that's a sign that things will do that here.
Just yesterday, the Fed cut its benchmark interest rate by 0.5 percentage point. Was that a surprise to you?
The market had priced in a 0.5 percentage point of a drop, and so it wasn't necessarily a surprise. If you ask me whether I think it's necessary, that's a totally different question.
Is it?
No, I don't think so. The one big plus I think it does do is basically if you look at mortgage rates right now, you probably for the first time will see rates with a 2% number in front of it for 30 years or 15 years. And that is unbelievable. So refinancing could put a lot of money back into people's pockets at this point. But as far as the economy goes, I do get worried that if we get down to zero, what else does the Fed have in its tool belt to use? So I'm a little concerned when we don't really need it. The corporate earnings do look good for the latter part of the year. So I'm afraid it's too much, but certainly will help the consumer as they pay less for their debt, and that will probably add more to the economy. And I think that's the purpose of it.
Let's take the Dow just for example here. They're trading above 26,000 points, I believe, at last check. Is there a number that we're trying to get back to? Is there a goal that we're looking at, hey, let's get back to 28,000 or 29,000 where we were before? Or are we okay with coasting above 25,000?
So if you look at the market having a 10% correction or more, which it did have, and we hadn't had one last year, and normally you get on average a 10% to 15% correction every 7 months or so. So we were overdue. There wasn't necessarily a catalyst before this outbreak to cause that. So that's what caused it. I think once it does settle down, you're going to get back to the numbers that you saw before, 29,000, 29.5, and then we're going to cross 30,000. I think that's where we're going to go. So that's really what I'd be looking for is once you get back up there, then I start getting worried about how high are we if the earnings don't kick in. So we have some room. The price-to-earnings ratios have come way down with this correction, so that's why people are piling in.
Each day it continues to change, and that's why we're glad to have you on board to help us understand it all. That is certified financial planner Doug Flynn. Doug, thanks so much. We look forward to talking to you a little later in National Report.